Hi, and welcome back to the Business Career College video series. We're going to have a look today at the annuity. Now, an annuity is really straightforward. Simply what an annuity means is a stream of income. So, a very basic type of annuity might see somebody invest, let's say, $10,000, and in exchange for that $10,000, you might get, let's say, $1,100 back per year for 10 years. That would be what we would refer to as a term certain annuity. So in this case, your $10,000 is gone, but in exchange for that, you have this $1,100 a year income stream. Very simple. For the purpose of the Life License Qualification Program, we are primarily concerned with a life annuity. And a life annuity differs from the annuity illustrated up here because what the life annuity is going to do is, as the name implies, it's going to pay benefits for life. So this annuity will pay until mortality. This product is typically associated with retirement. And the reason for that is because at a young age, somebody buying an annuity is going to receive a relatively insubstantial benefit. So on that note, we're going to have a look at the factors that determine the annuity. That is, how much annuity benefit will you get based on any of the following factors. So we just talked about one of them. One of them is the age of the person acquiring the annuity. An older person will get a better annuity. And the reason is that the insurance company, and life annuities have to be sold by insurance companies. They are exclusively an insurance product because they have a mortality component to them. That is, we would have to look at a mortality table to determine what the appropriate annuity rate would be. So an older person gets a better annuity. For example, if we have a 75-year-old and a 70-year-old both going to buy an annuity at the same time, the 75-year-old will get the better annuity. The 70-year-old could end up living longer and could end up drawing more funds in total as a result, but we don't know that at the outset. We are also going to look at the gender of the person acquiring the annuity. Because women generally live longer than men, insurance companies take more risk selling annuities to women. So as a result, men get better annuities than do women. Okay, and then we'd look at the principal amount. That is, how much money are you investing in this annuity? Now keep in mind, your principal is going to be gone here. So as I showed in the illustration up here, that $10,000 is gone, and in exchange you're getting that income stream. You're really purchasing this annuity. Somebody with $200,000 will have a larger annuity benefit than somebody with $150,000, all else being equal. So you want a larger amount of principal. There are other features that we can add to annuities that might make them particularly attractive. One of the downsides of the annuities is that I've given up my $10,000. That money's all gone. I might not be happy with that. I might say, I'd like to have the ability to get that back. And in response to that, I might purchase a commutable annuity. A commutable annuity means that I can turn my annuity back into cash. That feature would cost you. That is, the annuity that you initially purchased would not be as much benefit as an annuity that didn't have the commutable feature. So you have to pay to get that extra benefit. you could purchase an annuity that will help to deal with the risk of inflation. That is, you could buy an indexed annuity or an annuity with a cost of living adjustment, and this annuity will grow with inflation. There might be a cap on it. It might be that it will grow to match consumer price index to no more than, let's say, 6% a year. That feature is fairly expensive because what you're going to have now is an annuity where the benefit is actually going to increase. The insurance company is taking on some risk with that type of product. Now, I said up here that this annuity pays until mortality. That might not be exciting either. You might want an annuity that's going to last longer than your mortality. If I buy an annuity, an ordinary life annuity, and I get hit by a bus the day after I purchase that annuity, my annuity ends. That might not be exciting. And as a result, I might decide that I want some sort of survivor's benefits. And there are a couple ways that we can structure these survivor's benefits. One is that you might have a guarantee period. So if, for example, you buy a 10-year guarantee, and normal guarantees are going to be 5, 10, or 20 years. Those are your normal guarantees. If I buy an annuity with, let's say, a 10-year guarantee period, even if I die in 2 years, I know that the annuity will still pay a benefit for a continuing 8 years, or it will pay a benefit based on 8 more years. So if you die with a 10-year guarantee after 2 years, then one of two things will happen. Either a beneficiary gets a lump sum equal to your unused benefit. So this might just be a lump sum amount. Sorry about that. So the beneficiary might receive a lump sum based on the remaining 8 years until your guarantee would have run out, or the beneficiary might get the last 8 years of annuity payments. Both are possible, and it just depends on what insurance company you're dealing with. If you buy a 10-year guarantee and you live for 12 years or 15 years, your guarantee is useless because you've outlived your guarantee. But you have gotten the benefit you were looking for, which is that you did not have the chance to outlive that annuity. And then you might also purchase, typically with your spouse, although it doesn't have to be, it typically would be, you might purchase a joint and last to die annuity or a joint and last survivor's annuity. Both terms are correct. And a joint and last survivor annuity pays until the last spouse, pays until the death of the last spouse. It's not uncommon after the first death to have this annuity pay a reduced benefit. So it would be relatively common to see a maybe 60% or maybe 66 2/3%, or maybe a 75% benefit after the first death. So the annuity would be reduced after that first death. This is actually a very common requirement when you're leaving a pension. Most pension legislation holds that if you have a spouse and you're leaving a pension and going to an annuity, that this is the kind of annuity you have to buy. So this is usually required when leaving a pension or when taking a pension benefit. So those are the basic and most common features you'll run into with annuities. There is one other kind of annuity I'll mention very briefly here. We can also have what's called a deferred annuity or accumulation annuity. And this is really the insurance equivalent of a GIC. It's not going to pay any income. Instead, it's very much like a savings account, except that you can name a beneficiary and you have creditor protection like other insurance investments, such as the segregated fund. It's an accumulation product. You might purchase a deferred or accumulation annuity and then end up later on converting it into an income annuity, which are all the types of annuities we looked at initially. So this is really a savings type of product, not an income product. Okay. I hope that helps to understand how annuities work and what the benefits look like and the factors that are going to determine the amount of benefit. Annuities are a fairly important part of retirement planning because they do provide that guaranteed and fixed income. Also, because as we've seen down here, it's a requirement when leaving pensions typically that you have that joint and last survivor benefit. Please let me know if you have any questions. I hope this has been helpful.